Hi, this is Wanda Bowman, sitting outside on my patio enjoying this nice summer day, coming to you with a 5-minute crash workshop on credit card debt. One of the things I want to start out with is my personal opinion. I would advise not to go to a debt consolidation company. This is my own personal opinion. I'm not a professional, but this is my own personal opinion. The reason being is that when you go to the debt consolidation companies, what they do is they tell you to stop paying your credit card debt and pay them instead while they negotiate a lower rate. And many times their function is, that is their function. That is the purpose of the company, is to negotiate with credit card companies. And what they do is the money that you paying them, they take out their fees and also use the remaining balance of that to help pay the credit card settlement that the creditors have agreed to. But what they fail to tell you is when you stop paying your credit card companies, your interest rates are not being satisfied, and therefore your credit score goes down. It deteriorates. Although you're paying monthly to somebody, you're not paying the credit card company, and therefore your credit card score goes down. It declines. And this affects your future credit. It affects future lenders, and it also affects auto car insurance. A lot of times people don't know that. The debt consolidation companies don't tell them that, but it impacts more than just your credit card rate, but also insurances. What happens is auto insurers, they look at your credit card debt, and they look at your rates and your credit score when they go and try to insure you. They run a credit report, and they see that you have not paid a creditor for so many months, and you to them are a high risk, and therefore by you being a high risk to creditors, they feel that you will also be a high risk to the auto insurance company. So therefore it impacts your auto insurance and also future lenders. So here's what I want you to do. Just like that debt consolidation company can call your creditor and negotiate, you can do the same thing. That creditor company, just say you have $5,000 and you have about an 18.9% interest rate, you're going to end up paying an additional $3,000 on interest. So just say you pay for 10 years the minimum amount of about $200, you're going to end up paying them again the $3,000. So if you negotiate with them and say, you know what, if you will settle my debt for a lower amount, I'll pay a little bit of the interest, but not the $3,000. I will pay you in full. And you can do that by maybe borrowing money from a credit union or maybe a family member to try to get that bad debt off of your account. And so a lot of times they will do that to keep you as a company. So here's what I want you to know. The first thing you need to do, if they agree to settle with you, do not use your personal checking account to pay the settlement amount. Get a cashier's check or a money order. The reason being is if you use your personal checking account, they can come back to you later and say, hey, your financial situation has changed. Now you have a higher paying job, so you can pay this balance. And therefore, they can come back because they have your checking account number, and they can put a lien on your checking account. I have known them to do that to people that I've known in the past. And their checking account was locked. They could not use it until they came up with an agreement to pay that balance. Okay, so the first thing you need to do, again, is get that cashier's check, a money order, and have it for the amount that they agreed to settle. The second thing you need to do is write in the memo line of that cashier's check, this payment, if you accept, it pays my account in full. Therefore, again, as I said previously, they cannot come after you if you have a higher paying job and say, hey, I discharged the debt, but now you're able to pay, I want the rest of my money. So that was the second thing. Write it in the memo line. The third thing is ask them that when they report it to the credit bureau, they would say account paid in full instead of debt settled. If they say debt settled, then future lenders would see that on your credit report and they say, oh, I don't think I'm going to give them a credit card or a loan because they didn't pay the previous lender in full. They had to settle. I don't want that to be my relationship with them. And so they will not give you that particular loan or credit card. So that was the third thing. The fourth thing that I want you to do is ask them not to report the discharge amount to the IRS. Just say, for instance, your balance is $8,000, and they say just pay $5,000, and they discharge the $3,000 in interest. If they report that $3,000 to the IRS, that is considered reportable income. It's considered income because it was a gift to you from the credit card company that you didn't have to pay. So they would charge you taxes. The fifth thing I want you to do is get a secure credit card. Eliminate all unnecessary spending. A secure credit card takes your own money and puts it into an institution that allows you to have a credit card, but it's with your own money. So therefore, you're not a risk to that institution. But it also establishes a good credit rating. Your credit score goes up because you're showing a consistent pattern of paying that credit card on time. The sixth thing I want to say is, when you pay things, you put things on your credit card, once you get from the secure credit card and you have a regular credit card, if you can't pay it off within 30 days, don't purchase the item. Try to start developing habits of paying off your credit card debt in 30 days. But if it's a large purchase item like a washing machine or a dryer or something like that, then get a 12-month same as cash, where you don't have to pay any interest. All you pay is the principal. And what that does is it reduces the amount that you pay every month. You're just paying just what the purchase price of the item. But there's a trick to that. If you do not pay that full balance off within 12 months, they will retroactively go back and charge you all the interest that you save. Imagine that. For instance, if you pay $100 a month and the payment plan was for 12 months, your total payment should have been $1,200. So this say, for example, you paid the first 11 months timely. You paid the $1,100. All you have is a measly $100 left to pay. You forget about it. And you say, oops, a day after the 12-month period has expired, oh, I need to pay this. But what happens is you waited too late. That 12-month contract period has expired. So they'll go back retroactively, and all that interest that you thought you saved, now you have to pay. So these are a few of the high-level tips I want to share with you on today. These will help you. I will probably go in more detail in a future workshop. But right now, I want for you to take these little tidbits that I've given you on today to help you in your road to financial independence and your road to financial freedom. And until next time, let's continue our road to our financial glow up. Thank you for watching.